As the world 6.2. Last month it was
Positive.
negative 12.3. And remember, we had earlier the Empire Index and a major collapse there, down about 42 points. In this case, the Philadelphia Fed changes the other direction and goes positive. Philadelphia Fed new orders index is at negative 5 compared to negative 24.8. So that's an improvement, even if it's still showing a little bit of contraction. And the other thing about the Philly Fed is prices paid. Prices paid is jumping around on my screen here. But prices paid is 43.6 versus 52.2. So prices paid come down significantly in the Philly Fed. So the labor market stays strong, and another signal that maybe inflation is backing off just a little bit. We'll have to see how this all translates to the ISM the week after the Jackson Hole.
It's all relative, but the data pretty decent relative to what we were expecting this morning. Futures still positive, up 0.1%. I said that Treasury yields were lower by almost 5 basis points going into the number, now down just about 3 basis points lower to 2.86 on a 10-year, down about 3 basis points at the front end to 3.25. TK, the data's okay going into Jackson Hole next week.
Data's okay going to Jackson Hole, and of course that will drive forward to the speech of Jerome Powell. I like what our next guest says, Stephen Stanley, with us, chief economist at Amherst Pierpont Securities, where he goes back to Cool Hand Luke, and it may not be Paul Newman. He looks like Paul Newman. It may be Cool Hand Jerome that will speak there on a failure to communicate. Stephen Stanley, let's go to the Fed right now before Jackson Hole. How must they communicate as we stagger to Wyoming?
Well, first of all, I have to tell you, Tom, you're the first person that's ever compared me to Paul Newman, so I'll take that as a great compliment. So, yeah, it seems like every time the Fed tries to communicate and they pound the table, stomp their foot, however, whatever expression you want to use, that they're going to continue to tighten until inflation is brought under control, the markets find a way to take out of it something dovish. So that this happened at the FOMC meeting a few weeks ago. It happened yesterday with the minutes. The markets are focused on the idea that the economy is softer and that the Fed is not quite done yet, but that maybe by the end of the year it will be pretty close to done, and that it'll be easing by the second half of next year. And the Fed continues to push back hard against that, and the markets are just not having it at this point.
Stephen, did Greenspan communicate? I mean, long ago and far away, we used to decide if he was eating a ham or, a liver sandwich on the way to the Wednesday meeting. I mean, do you suggest that there's an over-communication now versus what we knew with Alan Greenspan?
There is a lot of communication. I think the Fed, they maybe are feeling a little bit regretful about the fact that they went to this thing of being very specific about what might happen at the next meeting. They did that a couple of times, and it didn't really quite work out the way they had planned, I suppose, and they stepped back from that in July. But it feels like it's a one-way ratchet. I mean, once you become more transparent and communicate more, it's very hard to take that back. And so I think the Fed is continuing to try to be explicit about what they're doing. At the end of the day, it's just a different view about the economy, I think. I mean, the Fed officials, for the most part, are continuing to push the soft landing story. The economy's fine, the labor market's strong, everything's going to be okay here. We're going to slow down, but we're not going to see a recession. And the markets are, thinking we're either in one or we're about to be in one, and not only is the economy weaker, but that weak economy is going to very quickly bring inflation down, which is another variable in the equation that I think the market might be a little bit too optimistic about.
Stephen, what they're picking up, I think most market participants that are reading this and thinking it's dovish, they're picking up a lack of conviction, a loss of conviction, and now two-way talk, where before it was just one way. And I'll tell you the couple of lines, and you've read them. And I know that the Fed minutes are very long and you can make them tell you whatever you want them to say. But these are the lines that jump out for me. It is likely that it would be appropriate at some point to slow the pace of policy rate increases while assessing the effects of cumulative policy adjustments on economic activity and inflation. That on its own is obvious, but pair it together with this. Many participants remark that in view of the constantly changing nature of the economic environment and the existence of long and variable lags in monetary policy's effect on the economy, there was also a risk that the committee could tighten the stance of policy by more than necessary to restore price stability. You put those two things together, Stephen, it totally undermines their effort to say the following. They reaffirmed their strong commitment to returning inflation to the committee's 2% objective. Stephen, that just does not sound as strong as it did a couple of months ago. Do they have to stop saying what they said in the minutes in order for people to believe essentially what you believe?
Well, as you said, I mean, the minutes are long, right? They're 12 pages long, so there's always going to be something you can pick out. And I thought it was interesting because that second quote that you read about many participants felt that there was a risk that they would overdo it, came at the end of a paragraph about risks. And the primary risk was that they were going to have to go by more, that inflation would stay higher for longer and force them to go by more than what they, their base case. And so, you're right. There are always risks on either side. And as I said, I think the market has a different view of the world right now than the Fed does. And as a result, they're willing to put more weight on the risks on the more dovish side. At the end of the day, I guess what matters most is what the Fed does as opposed to the messaging. And of course, the last two moves have been 75. They can't continue to go 75 forever. So this idea that they're going to slow down at some point, of course, as you said, it's obvious. But even if they go 50 in September instead of 75, the bigger question is how much longer are they going to have to keep going? And I just feel like inflation is going to stay high for much longer than what seems to be embedded in the markets right now.
Well, to that point about some of the stickier parts of inflation, I look at that Philly Fed number, which actually surprised to the upside. In theory, maybe that is having to do with some of the supply constraints easing at the producer level. That's goods inflation, though. And in services, that's where we're starting to see things really picking up on the wage front, on the rents front. If those are persistent, where does that leave the Fed, even if headline CPI is coming down because of gas prices?
Exactly, and that message was delivered in the minutes. There was, the sentence that I just mentioned that they said there was a risk that inflation would stay high for longer. There was another sentence in a different place that said they felt like it was going to take a long time for inflation to get back down to their 2% target. So I think in some ways, I mean, I talked about the debate over the economy and where the economy is, but the most important debate around monetary policy, in my view right now, is how long is it going to take for inflation to get back to normal or back to the Fed's target. And I just think we've had high inflation for long enough that while the longer term expectations numbers don't suggest that we've seen a sea change in how people look at inflation, you can just see in the straws in the wind that it's starting to become a fact of life for people. And I don't think it's coming down quickly. You mentioned rents, you mentioned wages. I think those are the sorts of things that are going to give inflation some staying power. I do have confidence the Fed will eventually do what's necessary and that we'll ultimately get back to something close to 2%, but it might take 2 or 3 years rather than 6 months.
Okay, so we had this conversation earlier. How long do you think they have to stay at the terminal rate when the market's expecting cuts within the next year? That not realistic?
Right. No, I think that's very unrealistic. And you heard that last week out of a number of Fed officials. I would be interested to see what the speakers today have to say as well. But I look at the dots and my own Fed outlook is a little more hawkish than what the June dots showed. But the June dots kind of suggest that the Fed expects to be at the peak rate for about a year before they start to ease. That's kind of how I read it. So I think that seems pretty reasonable to me. But they're not going to start easing until inflation is at least in the neighborhood of back to the 2% target.
Stephen, what's your peak rate?
My peak rate is 4 5/8. I have us getting there by around the middle of next year.
That's one heck of a number compared to what people are talking about on the street at the moment. Stephen, awesome to hear from you. Of Amherst Pierpont Securities, a Santander Group company. Stephen Stanley there, the chief economist. TK, that's a big number.
We're not used to it yet. And I mean, I'm sorry, Bloomberg Economics is even higher than that. John, the path to that is really what we're talking about, all of what we were talking to JP Morgan about earlier, is to me, it's the timeline there, and it's got to be a timeline that gets out into 2023. This is not going to get fixed by Christmas.
The time spent at that peak rate, Kaylee, ultimately, to get inflation back down somewhere close to 2.
And that's the thing, John, is that as we're having these conversations with economists, with strategists, all who are saying the market has this wrong, ultimately the market pricing is unrealistic, this market is fighting the Federal Reserve. So how hard does Chairman Powell fight back next week in Jackson Hole? Because clearly he has his work cut out for him.
Still waiting for confirmation of that speech over in Jackson Hole from Chairman Powell, Tom. We're assuming it's going to happen. I assume it's going to happen.
Well, maybe
we'll see who else is there.
Zoom or is he there?
I think in person, Tom. It's got to be in person. Come on.
What was the place you took me at Jubilee or Piccadilly? What's the breakfast place you took me to in London?
Where are you thinking? I can't remember, Tom. We've done this so many times.
Greer's or... It's like a morning breakfast place in London.
Are you thinking by Fortnum's?
Yeah.
I can't remember the hotel now.
I can't remember. It was expensive.
It's not the Wolseley.
Citigroup. The Wolseley. That's what it was. Citigroup out with an American equivalent breakfast on Krispy Kreme. John Tower says a Krispy Kreme donut. It's highly discretionary. John,
okay.
I think
that's a very different breakfast, Tom.
Listeners or viewers would
never had one
with that.
You've never had a donut,
You've never had a Krispy Kreme donut?
No, she's never had a donut, Tom. Never mind Krispy Kreme, never had a donut.
Oh, God, a sheltered childhood.
I'm not sure what's going on with that, Kaylee. We can talk about that another time. In the next hour, we will not be talking about confectionery and the fall. We'll talk about markets with Matt Brill of Invesco, Ella Hoxer of Pigtech.
Jack Manley wants to talk about foliage.
JP Morgan Investment Management. I think he's going to give that a miss. We'll do that going into the opening bell. This is Bloomberg.